Hey everyone, wanted to get you a quick update on mortgage interest rates, and today this one does matter. Mortgage bonds dropped hard today, over 80 basis points. That's a big move. This is drop, rates go up. There's a direct relationship, so let's take a look at what's caused it. A few things, and this is where it gets important. The economy isn't just local anymore, it's global. Right now, there's pressure coming from overseas. Central banks in Europe, including the Bank of England, are signaling that they may need to raise rates to fight inflation. And at the same time, there's concern about oil prices rising again. A big part of that is tied to the global supply routes, especially the Strait of Hormuz, which large portions of the world oil depends on that area to flow through and provide that oil. Even though the U.S. produces a lot of its own energy, much of the world doesn't. So when global oil prices go up, it puts pressure on inflation everywhere. And when inflation looks like it might stick around, bond markets react fast. Investors demand higher returns, and that pushes rates higher. At the same time, the Fed is in more of a wait and see mode. They're not rushing to cut rates right now, and that's adding to the pressure. So the market is adjusting to the idea that rates could stay higher for longer than expected. And here's why here's the important part. Markets they don't move in a straight line. That was a sharp move today when we look at it, but sharp moves can reverse just as quickly. We've seen that before. So what's that mean for you? When we look at the charts here, what we can see is that typically investors are going to put their money in one or the other. They will go with either in low inflation, we'll see bonds do better. Otherwise, you'll see them put that into the treasury notes. And as you can see, those are up well. When we look at kind of the highs over the last 2 years, it's kind of getting back up to that section. When we go back and we look at the mortgage-backed securities, remember this is inversed. So as mortgage bonds get more demand, we see that reduce rates. But whenever there's less demand on mortgage-backed securities, what ends up happening is they end up having to raise those yields, which is higher interest rates. And so as bond prices drop, you'll see that puts upward pressure on rates. And as you can see here, we were kind of climbing pretty nicely up at this 100.45 level, all the way down now to 98.14. So almost 200 basis points in the last couple of weeks since the conflict started. When we look at this is over the last 6 months. If we go back over full 2 years, you can see, this was our best spot. This was our low point. Over the last 2 years, we're still not anywhere close to that, but definitely moving in the wrong direction. So we'll keep an eye on it for you. And hopefully we'll see some resolution to all of this. Keep in mind, if we do see that resolution, and I think with more nations stepping in to kind of patrol and protect that area, we could see this maybe as far as the Strait of Hormuz opening up sooner, and we could see this reverse pretty quickly as well. So, but that's what's going on. Rates much worse today than they were a week ago by far. So we'll keep you posted. Have a great day.